Okay, we'll now start with chapter 21. And chapter 21 deals with budgets. Now, a manufacturing business would prepare lots of different types of budgets, and they go through those in the chapter. They mention a couple of types: flexible budgets and static budgets. Static budget you could just set in stone at the beginning of the year. You pretty much know what those numbers are going to be for the year. But a flexible budget, as the name would suggest, provides a little bit more flexibility. We can change the numbers as new information comes to light. So your sales budgets, your direct materials purchases budget, some of those would have to be flexible. We need to roll with changes as new information comes in. Something like the budget for human resources, that might be pretty much supplies and salaries, and you can pretty well know what those are from last year, so that one might work well as a static budget. Now, the first step in the budgeting process is estimating sales levels. Once those are expected, then we will tie production to expected sales. We want to produce all we can sell. We just don't want to produce a lot more than we can sell. So your operating budget, start on page 989. The first one you do there will be your sales budget, then the production budget. Then a production budget has tied to it direct materials purchases budget, the direct labor cost budget, and the factory overhead cost budget. All right, then you prepare selling and administrative expenses budget. Have yourself a budgeted income statement. All these would tie together, you guys, to form including the cash budget and the capital expenditures budget. It all come together to form the master budget for a company. I think the one we're going to look at in this chapter, I think it's one of your more detailed ones, and I think it's one you're probably most likely to run into somewhere outside this class. We're going to take a look at the cash budget, and you can see a nice example of one of those on pages, starts talking about it on page 997 and runs through page 1000. You see the example of the budget itself on bottom of page 1000. And the supporting schedules are on pages 998 and 999. Collections of accounts receivable and collections for schedule of payments for manufacturing costs. So what we're going to do is prepare the cash budget. Look and see where all we expect cash to come in from and where all we expect cash to go out to over the next 3 months. And we'll go ahead and set that up, and that way we're preparing it here on May the 1st. That way if we show that we're coming up with excess cash or cash deficiency in June or July, we can go ahead and work to correct that here on May 1st instead of waiting till sometime in July and letting it be a surprise. Okay, so you would start with a heading, Sonoma Housewares Incorporated. This is our cash budget. And notice it's dated for the 3 months ending, ENDING, July 31st, 2016. It says ending because it hasn't happened yet. Remember, we're at May 1st. So we'll start with our first section. Is called Estimated Cash Receipts From. And let's read through the problem. It says the controller of Sonoma Housewares Incorporated instructs you to prepare a monthly cash budget for the next 3 months. You're presented with the following budget information. Okay, they give you sales for May, June, and July, as well as manufacturing costs, selling and administrative expenses, and capital expenditures for those 3 months. Then they give you some additional information in the next 2 paragraphs. In the first instruction, they ask us to prepare a monthly cash budget and supporting schedules for May, June, and July 2016. Okay, so the first place we'll start will be cash sales. And notice in the first sentence, first paragraph below your chart, the company expects to sell about 10% of its merchandise for cash. So each month's sales number, 10% of that month's sales number will be cash sales. So May's sales number was 86,000 times 0.1 gets us 8,600 cash sales for the month of May. All right, June sales in total from the chart 90,000 times 0.1, just $9,000 June's cash sales, and then 95,000 times 0.1, just 9,500 cash sales for the month of July. Okay, now we need to read a little further. They tell us of sales on account, 70% are expected to be collected in the month following the sale, the remainder the next month or the second month following the sale. So in May, we will collect 70% of sales made on account in April, and the other 30% of sales made on account in March, 70% of which got collected in April. So let's go to our chart. We have a separate chart to calculate collections from accounts receivable. Here we go, collections of accounts receivable. Okay, March, sales made on account. Well, total sales for March were 86,000. Minus cash sales gets us to, or excuse me, that was May. March sales made on account. We need to read a little further. Come down to the second paragraph, second row. It says we have, let's read starting with the second paragraph. Current assets as of May 1st include cash of 33,000. We'll come back to that. Marketable securities of 40,000. Here's what we're looking for. And accounts receivable of 90,000. 72,000 from April sales, 18,000 from March sales. Sales on account for March and April were 60,000 and 72,000 respectively. So sales on account for March were 60,000. Okay. 70% of March sales made on account would have been collected in April. The other 30% will be collected in May. So it equals 60,000 times our 30%. Just $18,000. Now that takes care of March sales. 70% of the 60,000 would have been collected in April. Right. The other 30% of the 60,000 is collected in May. All right, now we'll go to April sales. All right. All right, so first we're looking for April sales made on account. Okay. Sales on account for March were 60,000. For April were 72,000. April sales made on account 72,000. 72,000. Okay. May sales, April sales collected in May would be the 70%. So equals 72,000 times 70%, 50,400, and then 30% of the April sales made on account will be collected in May. You probably caught that one already. I had that one in the wrong space. This is April sales collected in June. Okay, 70% of April sales made on account would be collected in May. The other 30% of April sales collected on account will be collected in June. So that's our 72,000 times 30%, 21,600. That takes care of April sales. All right, May sales made on account. Well, we know May sales in total are 86,000 minus the cash sales from May. Those were not made on account, never a part of accounts receivable, and don't have to be collected later. So May sales made on account would be equal to 86,000 minus 8,600. Okay, when we make sales on account in May, we'll collect 70% of those in June. So it's going to be equal to 86,000. I wanted to subtract out the 10% over here, but you're going to instead have to multiply by 0.9 over here. That gets the 10% subtracted out. Then times 0.7 gets you the amount actually collected in June, 54,180. Alright, 86,000 again. But remember, this is going to be May sales collected in July. Remember, only 90% of those were cash sales. Or excuse me, were sales made on account. The other 10% were cash sales. So times 90% gets you to sales made on account, times 30% gets you to the amount of May sales actually on account collected in July, 23,220. Okay, June sales in total were 90,000. Alright, we won't collect any of those in May or June. We'll collect 70% of the June sales on account in July. But first we have to get to cash sales, so we'll multiply times 0.9, and then we'll multiply times 0.7, so we get 56,700. You could have also said 90,000 minus the 9,000 cash sales for the month of June, and then just multiply by 0.7. It's just the same thing either way, 56,700. Alright, now notice we'll have two numbers collected in each month. The 18,000 collected in May, that's the 30% left over from March sales. 70% of April sales made on account are collected in May. 30% of April sales made on account are collected in June. Then May sales made on account, well, first we have to say May sales in total times 0.9 to get 90%, or subtract out 8,600. See, watch, it'll work this way too. Equals 86,000 minus 8,600. And then we're going to multiply by 0.7. Get the same thing either way, 54,180. Alright, then May sales on account, 30% of those will be collected in July. I multiply by 0.9 to get to the sales on account. Again, another way to do that, we say 86,000 minus the 8,600 in cash sales, then multiply by 0.3 or 30%, and that gets you the amount of May sales on account collected in July. Then when we make sales on account in the month of June, 90,000. So we got 90,000 minus 9,000. That's total sales for June minus June's cash sales times 70% the amount of sales made on account in June that will be collected in July. And that gets us to 56,700. Now we just want to total each month. And now we get our collection of accounts receivable. 68,400 for May. For June, 75,780. And then for July, 79,920. Okay, so now total cash receipts. You guys, if you read through the rest of the problem, you won't see cash coming in from anywhere else. So that takes care of this first section. Cash receipts from. Alright, so we get total cash receipts from each month. 77,000 for May, 84,780 for June, and 89,420 for July. First, the way we did that, to get cash sales, you took each month's sales number, which was 86,000 for May, multiplied by 0.1 or 10%. 90,000 for June times 0.1 or 10% gets you 9,000. And 95,000 for July times 10% gets you 9,500. Now to get these three numbers, we came to our chart below. They said when we make sales on account, that 30% will be collected in the month, in 2 months after the sale. 70% will be collected in the month following the sale. So we'd start with March sales. Well, 70% of March sales on account would have been collected in April, so it won't affect this budget. The other 30% of March sales made on account would be left in accounts receivable on May 1st. So they're telling us what? March sales on account in total were 60,000 times 30% will be collected 2 months after the sale. That gets us to 18,000 for May. Then April sales, they tell us April sales on account were 7,200. times 70% will be collected in the month following the sale, or May. 30% will be collected in 2 months following the sale, or June. Now May sales, these are actually not May sales on account, but May sales in total. Remember, the first thing we got to do to get the amount collected, the 70% collected 1 month later, would be to multiply this number by 0.9 or subtract out the 8,600 cash sales. So see, that's what we did. We said 86,000 minus the 8,600 cash sales from above, right here, and then multiplied by 0.7 the amount of May sales that would get collected, the amount of May sales on account that would get collected in June. Okay, now this one is going to be the same thing, except it's 86,000 minus the 8,600 times 30%, the amount of May sales on account that would get collected in July. And now this one is 90,000 June sales in total. Well, we have to subtract out the 9,000 cash sales for June. Then times 0.7 gets us the amount to be collected in July. Now we added these two together to get this amount. We added these two together to get the total from June. And we added these two together to get the total from July. Then we just moved these three totals up to collections of accounts receivable on our chart here. Then to get these numbers, we just added these two together. Add these two together to get this one, and add these two together to get estimated cash receipts in July. Okay, we'll start back with estimated cash payments for in the next video. Thanks.